What's up, traders? Welcome out to tonight's presentation on naked puts. Naked puts is Coach Tyler Craig from Tackle Trading. Excited to be here. Got a nice little PowerPoint slide to guide us in our conversation tonight. Before I dive into what a naked put is, why I love them, how to trade them, just in case this is the first time you've watched a tackle trading video, we have an educational ecosystem that'll knock your socks off. If you want to learn how to trade, you need educational content, you come to the right place. Right here, I got a nice little wheel that goes through all of the glorious content that we offer at tackletrading.com. And we are having a sale right now. 2022, you had a lot of inflation in 2022. Okay. Do you know where you didn't have inflation? Tackletrading.com. You've had deflation. We just slashed the price of everything, doing our part to help the common folk combat inflation, making everything cheaper for you. You can go to our store tab on tackletrading.com or visit bit.ly/tackle holiday. Check out all those glorious discounts and generous offers here at this Christmas season. And if you're like, man, you guys offer a lot of content, I don't know where to start. Well, we'll help you out. You can schedule a consultation, talk with any of the tackle coaches about your situation, and we'll custom fit or custom tailor an educational plan for you. So tackletrading.com/schedule-consultation. Okay. All right. Let's rock and roll. You got my face in front of you, but here I was a little younger. Okay, a little younger. Again, I'm Coach Tyler Craig with Tackle Trading. I'll be the instructor tonight, and got a topic that's near and dear to my heart: the naked put. So here's how we're gonna do this. I got a few slides. We're gonna go through some basic definitional things, see if we can bring you up to speed on how the options market works and what are the unique characteristics of a naked put. And then I'm going to go jump on a trading platform and go build an example for you and talk through how to place the trade and maybe think through some management choices. So my hope is that at the end of this conversation tonight, you're feeling pretty comfortable about the perks, the advantages of the naked put. You got kind of a starter game plan on how to use these in your own trading. Okay. I do have my tablet here, a handy dandy bamboo tablet. Got my stylus. We're going to be taking some notes tonight, and let's rock and roll. Okay, what is an option? We're not talking about stock specifically here tonight. We're talking about the derivatives market. An option contract is a derivative. It's a contract specifically. And here's the definition, okay? An option's a contract between a buyer and a seller. So there's two parties to every transaction, just like in real life, okay? People buy things, people sell things. There's a contract between a buyer and a seller. If you buy the contract, we say you're the purchaser of the contract for obvious reasons. When you buy an option contract, you get rights. You have the rights to do things, okay? And it's important when you buy a contract, you have the right to do something, but you don't have to, okay? You're not obligated to do it. You can do it if you want. And the thing that you have the right to do is either buy a stock or sell a stock. So some contracts give you the right to buy stocks. Some contracts give you the right to sell stocks. What price do you have the right to sell the stock at or buy the stock at? Well, that's specified in the contract. So it may say, hey, you got the right to buy this stock at $50 or $100 or $150. It'll be specified in that contract. And it'll also tell you how long you have the right to do that. Options are limited. Yeah, they don't last forever. They have an expiration date. And so one of the kind of tricky things of the options market is if you were trading Microsoft stock, there's one Microsoft stock. Anybody who wants to buy or sell Microsoft, there's one asset or one underlying that they can play with. Not so in the options market. They list contracts that expire anywhere from a day from now to a couple of years from now. So there's just a buffet of choices when you get into the options market. And it can be a little bit confusing at first, but what we try to do to make it simpler is we just come up with some specific rules to get you a good starting point. And rather than having to investigate and explore every single potential choice, your rules will narrow down the list of choices and allow you to make quicker decisions. So I'm going to give you some tips tonight, some best practices with naked puts, some rules to help you understand maybe which options we're going to trade with this particular strategy. So I've said put a couple of times. Let's familiarize ourselves with what is a put versus what is a call. These are the two different option contracts we have the ability to trade. Okay. And in our education, listen, there's dozens of ways to use these two instruments, calls and puts. You can buy them, you can sell them, you can do spreads. But fundamentally, you just got to understand, what is it, just a plain vanilla call option here. This gives you the right to buy stock. The reason the telephone is appropriate is when you want to make a call, you pick up the phone. So when you hear calls, you should think up. People who buy calls are doing so because they think the stock's going to go up. It's a bullish trade. So a call option, when you buy it, it gives you the right to buy stock. Okay. And again, there's a set price that you have the right to buy the stock at, and there's an expiration date. Okay. Well, puts, when you're done with your phone call, you put down the phone. So when you hear puts, you should think down, as in you want the stock to go down when you buy a put option. So put options give you the right to sell stock. Okay. Now you think, oh, I'm so confused. You're talking about buying puts, and it gives you the right to sell. Listen, some of the vocabulary at the beginning is a little tricky. Okay. A little tricky. Just need some repetition here, but just remember, puts down. People who buy puts do so because they're bearish. Put options go up in value as the stock goes down. That's why people buy puts when they're bearish. It's an instrument that makes them money as the market goes down. And the reason it does that is because in the fine print of that contract, it gives you the right to sell the stock. And if you've got the right to sell the stock right here, and the stock's going down, 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 that contract's worth a lot, because you're getting the right to sell the stock at a higher and higher premium versus what's available in the current market. Like a call option, there's a set price that you have the right to sell stocks at, and there's an expiration date. Okay, they don't last forever. Well, when I first started learning options, and as you first start to learn options, the order of operations here is you learn about calls, you learn about puts, you learn that you can buy a call and you can sell a call, you learn that you can buy a put and you can sell a put. Now, those four things are just the four fundamental transactions upon which everything is based in the options market. So if you're a new options trader, your objective here, your learning curve, is learn how to buy a call, learn how to buy a put, learn how to sell a call, learn how to sell a put. And there's some interesting characteristics. Each one is unique in the way that it behaves. Okay. Now, I can't teach you all four in 30 minutes here, but what I can do is focus on one of the four. Okay. We're going to talk about selling puts tonight. We're going to talk about selling puts. A naked put option is nothing more than selling a put. Okay. It's an interesting trade. So one of the ways that I like to think through the options market and those four basic transactions is to think about how you make money, or when you make money if you're using one of the four. So I got a nice little matrix here. Okay. Now on the top of the matrix, let's put my bamboo tablet to work here. Go yellow. You've got the four basic strategies, right? Buying a call, selling a call, buying a put, selling a put. So four columns. Okay. And then on the horizontal axis, the rows, if you will, you've got the stock price behaving in different ways. Okay. Three different ways. Okay. I hope this isn't a shocker here, because it's pretty intuitive. Stock can go up, stock can go sideways, stock can go down. I've yet to come up with another way the stock can go, because I'm pretty sure that encompasses all potential outcomes: up, sideways, down. Well, what's interesting is you go through this and you learn the characteristics of these four basic transactions. How do you make money? Well, if you buy a call, is a bullish transaction. Okay. Gives you the right to buy the stock. You only make money if the stock goes up. Okay. So again, column one here, buying a call. Row one, stock goes up, ding, 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 you make money. What if I buy a call and the stock goes sideways? Boo, you're not going to make money. Okay. Boo, you're losing money if the stock goes sideways. What if you buy a call and the stock goes down? Well, you're losing money even faster, quite honestly. Not good. So 1 out of 3, you'll make some money. Okay, that's all right. What about selling a call? Well, it's the inverse. It's the inverse. If you sell a call option, it's actually a bearish trade. It's actually a bearish trade. So if the stock goes down, you make money because that's by definition what a bearish trade does. Cool thing about selling a call is that you actually also make money if the stock goes sideways. Where you don't make money, as is the case with any bearish leaning trade, is that the stock goes up. So stock up, not good for selling a call. Well, if this was a conversation today on selling calls, we'd spend some more time on that, but it's not. Let me get to the puts. Buying a put option. It's a bear trade, just so you know. It's a bearish trade. So as you might imagine, you will make money if the stock goes down. Ding, ding, ding. Do I make money if the stock goes up when I'm buying a put? Well, no, because it's bearish, silly. Bearish and up are opposites. They're opposites. You will not make money if the stock goes up. You also won't make money if the stock goes sideways. You need the stock to go down to make money when you're buying a put. Interesting. Okay, the fourth, and I think most compelling of the four here, is selling the put. Okay, this is commanding our attention today. Couple of stars for emphasis. If you sell a put, this is a bullish trade. So you should make money if the stock goes up. Naturally, with any bullish trade, I mean, you're probably going to lose money if the stock goes down. Okay. But the cool thing about selling a put is you make money if the stock goes sideways. And if I'm being picky here, you can still make money if the stock goes down. It just can't go down too much. Okay. So when I think about my bias, or forget Tyler's bias, when I think about the behavior of the stock market, and I think about most of the time, what does the stock market do? I say most of the time. I'm talking like not just this year, okay? Can't just look at 2023. I'm talking over the past 10 years, 20 years, 30 years, 40 years, 50 years. You know, if you're gonna try to figure out like what happens most of the time, you got to look at a pretty big sample size. And you know what you discover is most of the time, the stock market goes up or sideways. Most of the time, the stock market does not go down. Contrary to what's happening this year, okay, most of the time, the market goes sideways to up. In fact, statistically, if you look at the S&P 500, which we use as kind of the benchmark, the proxy for the U.S. stock market, and since the U.S. dominates the world, you might as well think of it as the global market index. If you want to know what stocks are doing, and you have to pick one index, S&P 500 is probably going to be it. It goes up about 3 out of every 4 years. Okay. Only about 1 in 4 will the market go down. Okay. You're experiencing one of those this year in 2023. But the point is, if you're going to pick one strategy, don't you think you should pick the one that is most in harmony with what the stock market does? I think so. One of the benefits of selling puts is that you win most of the time because it profits in the environment that we find ourselves in most of the time, which is neutral to bullish. So let's get into the definition here, a little bit more on what it means when you sell a put, okay? And one of the things you'll discover with options is that there's a lot of synonyms, okay? If I ran the world, I'd be a dictator. Well, let me be more specific. If I ran the options market, okay, the entire industry, I'd be a dictator and I'd say, listen, no funny business here. Let's all use the same terms to refer to the same thing so we make it super simple. So I'd say, listen, when we are selling a put, we're going to call that strategy selling a put, okay? When we're buying a put, we're going to call it buying a put. That's all. Okay. And then the clever schmuck who said, you know what we should call selling a put? We should call it a naked put. We should call selling a put a naked put. I'd say, no, you're not in charge. I'm in charge. We're not going to use that term. Okay. But that's not the case. I'm not in charge. Okay. I didn't make up the vocabulary. I didn't make up the terms. And so, just so you know, a naked put is just another way of sell a put option. When you sell a put, when you short a put, you are entering a naked put position. Okay. And there's some reasons why they call it a naked put, but it's just a synonym. We're just selling puts. Okay. Now, what does that mean? Well, it gets back to rights and obligations. When you buy a put option, you have the right to, excuse me, I almost said it wrong, sell stock. You have the right to sell stock. Okay. Well, who are you selling the stock to, man? Like if you got the right in this contract to sell the stock, somebody's buying it from you. And it turns out the person buying it is the one who is on the opposite side of the trade, the one who entered that contract with you. So when you sell a put, you're the one who's promising, you're bringing on the obligation to buy stock if the person who owns the put option decides to exercise. So there's a vocabulary term. When someone owns a contract and decides to make good on the right that they have, they exercise the contract. That means somebody on the other side of the transaction, somewhere in the world, is going to get assigned. So if I'm the black horse here and I say, all right, stock's dropped, I've got the right to sell the stock at $100. I'm going to call up my broker and say, hey, I'm exercising my contract. Sell the stock at 100. They spin a big wheel. And it lands on some broker out in the world that has a client that's short that contract. Okay. And so randomly somebody's going to get assigned and they're going to say, hey, mister, remember when you sold that put option and you promised, you obligated yourself to buy the stock? Yeah, you got to make good on that. Joe Schmo over in Alabama is exercising here. You got to buy the stock from him. And so you get assigned and you buy the stock. So one of the potential outcomes when you sell a put is that you might have to buy stock. You might have to buy stock. And maybe that's a good thing. Maybe you wanted to buy stock. Maybe you wanted to buy stock. So see, one of the ways that you can think about a put, lots of ways, but one of the ways that's interesting here is that you get paid to buy stock. You get paid to buy stock. And, you know, it's like a win-win because you may say, dude, I would have bought the stock anyways. You're going to pay me to do something I was willing to do anyways? Great. Sign me up. Sign me up. So why do we sell put options? Well, sometimes we sell puts because we want to buy the stock. And we're no dum-dums. It's like, well, why buy the stock right now if somebody will pay you to buy it later? Maybe I'll get paid to buy it later, right? Or what if somebody would pay you to buy it at an even lower price? So it's like, well, okay, the stock's around $100. I'm a willing buyer at 100, but I'll tell you, if I could pick it up at 90, I'd be even happier. Well, you could sell a 90 put. I don't know, maybe you get paid $1. Maybe you get paid $1. We'd say $1 credit. Okay. And then you now are on the hook to buy the stock at 90. Okay. And if it goes down there, I mean, it's got to go down to 90 or else you're not going to get the chance to buy it. But let's say it goes down to 90 and you pick up $1, whatever you get paid up front is yours to keep, by the way. You get paid the $1. You end up buying the stock at 90, a stock you liked anyways. Great. Now, I mean, you're not going to feel great if the stock goes down to $50. Okay. I mean, hopefully it's a fundamentally sound stock, one that you think long-term is going to go higher. There's no, this isn't without risk. Okay. But it's less risky than just buying stock outright. Okay. Selling a put, you do it right, you don't over leverage yourself, can be a smarter way of picking up bullish exposure, a way of setting yourself up to buy a stock potentially at a discount. So I'm going to go into some more details here in a second. Okay. There's actually another way I want to position this, but just a little teaser here. Okay. a trailer, okay, of coming attractions. We're going to talk about covered calls, I think, in our next YouTube webinar. And a covered call involves buying stock as part of the transaction, buying stock and selling a covered call. Well, instead of buying stock outright, a lot of people will sell puts as their avenue to getting long the stock. So it's like the front end of a covered call potentially. And so you might have somebody who's selling a put and trying to get put the stock. And then, you know, maybe it happens the first month, maybe it doesn't happen until the second month or the third month, but, you know, they keep selling puts, the stock drops eventually, they get assigned, and then boom, they sell a covered call. So you'll see this natural rotation between selling puts on a stock that you want to buy and then getting assigned the stock and then selling covered calls. And these are just ways of using options to enhance stock ownership. Okay. So another way you could think about selling a put, again, getting paid to buy something, buy a stock you want to own. Another way to think about this, though, is if the stock doesn't go down, let me go to my next slide here. Let me get a little more space. Let's say it's this $100 stock. So I got this $100 stock and I sell the 90 put, right? So I sell the 90 put. I'm digging this color change, by the way. Sell the 90 put. I get paid $1. Okay. Well, if the stock goes up, I'm not going to be assigned. I'm not going to have to buy this stock at 90. In fact, this put will just expire worthless at expiration, and I just make $1. Okay. And so sometimes we refer to this as a cash flow play. I sell a put and I got the potential to make some cash flow if the put remains what we call out of the money, like below the current stock price. So in the event the stock goes up, you don't have to buy it. The put just expires and you make some money. If the stock goes sideways, again, you're not going to be assigned. You're not going to have to buy shares. The put will expire and you keep the $1. If the stock goes down, but in this case, down less than $10, again, the put expires and you keep the $1. And you think about the likelihood of the stock going up or sideways or down less than, in this case, 10%. It's a pretty high probability outcome. So you have a high probability, there we go, of generating some cash flow. And so a lot of the outcomes result in you just pocketing the premium. And so a lot of people look at naked puts, not just as a way of getting paid to buy stock, but also as a way of generating a high probability of capturing some cash flow. In other words, a profit. There's a high probability of profit associated with the naked put. Okay. And when you think about the current environment, 2023, long stock, making money buying stock has been a challenging proposition because the market's wacky, it's volatile. We've had some moments where we've had a nice uptrend. And then J-Powell comes in. He's like, no, bozos, we're taking interest rates to 25% and we're going into a depression. Why would you ever buy stocks, you idiots? And we're like, oh, sorry. And the market takes, right? All right, back to the coal mine, back to, being hard to make money. And that's happened again and again and again. And I'm being partially sarcastic here. But the point is, uptrends in the market this year have been short-lived, okay? And we've gone right back down. And so, man, you've had to be like really, really tactical and quick to try to make money buying stock because they've been temporary, those uptrends. Now, eventually we will go back to a bull market. It always happens. But man, this year has been a year where you probably would have done better embracing some of the higher probability aspects of options trading, right? I suspect if you sold puts correctly this year, you've done better than if you were just straight up buying stock, because there's no margin of error when you're buying stock. You don't have a high probability per se. It's like 50-50. You can build naked put trades and similar positions that have maybe an 80% probability of profit, where you can win even if the market goes down. It just can't go down too far. And so these strategies they look really smart, honestly, in an environment where the market's neutral, maybe bearish. I got to be honest, when the market goes straight up, long stock's pretty good. Okay, it's pretty good. Go for the jugular, just buy some shares. But unfortunately, we're just not in that environment right now. So naked puts are pulling their weight here over the last year or so. All right, so let's look at some live examples. I think you got the general idea here. I'm gonna let it sink in or help it sink in. Okay, we're gonna pull open some charts. I'm gonna go to Thinkorswim here, and I'm just gonna build out some guidelines, some general rules that I think will help you be more successful. Okay, help you be more successful with selling puts. Okay, with selling puts. So, all right. Naked put playbook. All right. So I'm going to sell a 1 to 2 month out of the money put option. See, when you sell puts, you could sell a put that expires tomorrow or a month from now or a year from now or 2 years from now. You got plenty of choices. But what you'll find is most people kind of gravitate towards maybe selling around the 1 month option. Little longer is more conservative, little shorter is more aggressive. The thing about a month is that options experience what's called time decay. They lose money as time passes, and that rate of decay accelerates as you get closer to expiration. Now, when you're buying something, you want it to go up in value. Okay. This is not that. We are not buying something. We're selling something. We're selling a put. And we want the put to go down in value. Anything that causes the put to go down in value is good because we're short that put. And so if you sell a 1 month put to 2 months, 30 days, 45 days, something like that, that's kind of where time decay really starts to accelerate. And people want to capitalize on that when they're selling options. Okay, so 1 to 2 months. You'll see some traders go a little closer. I don't know very many that go further out than 2 months, quite honestly. But 30, 45 days, kind of the sweet spot. Now, what does it mean to sell an out of the money put? Well, that just means you're below the current stock price. Okay, so if the stock's right here and you're like, I'm willing to buy it if it goes down there, like right here. Well, that put that's down there that gives you the right to buy the stock at a discount relative to the current price, that's out of the money. It's below the stock price. So you can sell in the money puts. Most people that are using short puts aren't doing that though, okay? And so to start out with, usually you want to obligate yourself to buy the stock at a discount, which would translate into being out of the money. Now, how far out of the money? Well, listen, you decide, but if you want a high probability of profit, okay, if you sell a delta, there's a new term, maybe less than 20, that ensures you have a probability of profit that's over 80%. Okay. So this is something that we'll just have to be brief on because I'll spend 3 hours if I go a deep dive into Greeks. Okay. We do deep dives into Greeks, just not tonight. But essentially, the delta tells you the likelihood that the option is going to expire in the money or out of the money. If it expires out of the money, you win. Okay. And so the delta 20 means there's a 20% chance it's going to be in the money. And the inverse of that is 80% chance it's going to be out of the money. Okay. So if you want a high probability, you sell lower deltas. Okay. So those are some rules of thumb here. And of course, when you're picking a stock, you're trying to pick a stock that's not going to tank. All right. When you're timing the entry, if you think the stock's going to go down over the next couple of days, then don't do the trade. Wait for it to go down and then sell the put. This is a bullish trade, right? So your bias here is neutral to bullish, and you're trying to kind of pick the bottom like any other bullish trade, right? So a lot of stocks right now, not looking so hot. If I pull open the S&P here, it's gone down like 5 straight days. Okay, just not great. Well, if it's going to go down a 6th day and a 7th day and an 8th day and a 9th day, like we might as well wait. Might as well wait and not sell the put. Okay. But let's pretend like the world doesn't end in the next week, and this sell-off finds support somewhere and starts to go back up. Okay. Well, the moment you get enough confirmation or evidence that we've kind of found a support zone, okay, and we're starting to go back up, that would typically coincide with a decent time to sell a put. Now, we can quibble over whether you do it on SPY or some other ticker symbol, but just go with me on the timing here. You're trying to get in at the low point, whenever whatever downtrend or downswing is in place terminates, you get in advance. That's when you want to pull the trigger. Okay. One of the things that I like to look at is just breaking the prior day's high. Okay. This isn't me. This is just pretty textbook technical analysis stuff here. But look, I mean, do you see the pattern that the S&P is on? Red bar with a lower high, red bar with a lower high, red bar with a lower high, red bar with a lower high. I don't see any support. All I see is relentless down, 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 down. Now, I don't think it's going to go down forever because it never goes down forever. At some point, we're going to get an up day. And that could be a moment where somebody enters a naked put or some other kind of bullish trade, right? When you get a bullish trigger. It's not rocket science. So if we break today's high tomorrow, and I really, really wanted to sell a put in the S&P, I would like that trigger a heck of a lot better than selling today, just guessing this is the end of the downswing. Okay. And so waiting for confirmation is important with a naked put, just like with any other bull trade. So if I'm going to go look for a stock to sell a put on, I mean, one consideration here in terms of finding candidates, okay, pick a stock or ETF you're willing to own. That could be an obvious one. So whatever criteria you use, the price, you may say, well, Tyler, I mean, I can't buy 100 shares of the S&P because I have a $5,000 account and the S&P is around $400. It'd be $40,000 to buy 100 shares. It's too expensive for me. Even if I bought it on margin and I borrowed half of the cost, it'd still be 20 grand and I only have a $5,000 account. So that's too expensive. I will tell you that people like to sell puts on cheaper stocks because if they get assigned, they don't have to put up as much money. But I don't know. It depends on your account size. Okay. I'm not adamantly opposed to selling puts on the S&P. If you've got the money and that's how you want to allocate, fine. But pick something that you're willing to own. Okay. Bonus, if the chart looks good, okay. I mean, you could say, hey, you know what stock I'd really like to own is I'd like to own Coinbase. Now, I won't question your sanity. Okay. If you want to play Coinbase in the midst of a freezing cold winter in crypto, be my guest. The one thing I might say, though, is it's at an all-time low, and the chart looks horrific. Okay, just terrible. I wouldn't show my kids this because they'd have nightmares at night, right? And be sleeping in my bed. Why did I show them Coinbase? I shouldn't have done that. I knew it was a spooky chart. Okay, I don't know. Why don't you wait for it to go into an uptrend? Like, just saying. I mean, maybe you can wait for the chart to stop going down every day. To get some stability, right? So, the normal technical signals you're looking for on a bullish, any other kind of bullish trade, right? So whatever I don't know, fundamentals, technicals, whatever you're using, I'd like it to look decent, right? So, I mean, I don't know, silver hasn't gone down lately. It's kind of gone up. It's in an uptrend, right? It's pulled back a little bit. That's kind of a nice bullish looking trend, right? So I feel a little better selling puts on something that looks like this than say Coinbase, right? That's just me. So I got to look at an example though. I mean, the chart of silver was good. Gold stocks have been decent. They're getting beat up a little bit right now. There's just some cheaper ETFs. Quite honestly, it is not the easiest to find quality bullish charts right now. It's just not. It's not the easiest. But Workday made an appearance in our scouting report this past weekend as a nice little bullish looking chart. Okay. That one still looks okay. Right. Another one was Okta, OKTA. right? That recently started a little uptrend, right? Pulling back a little bit. So there's some charts out there. So why don't I do this? Let's go with Okta. Okay, let's go with Okta. Let's say that you think this is going to completely get obliterated. All right, and you're a buyer of the dip. Well, you probably want to wait for an update, want to wait for a trigger. But I could buy the stock right now for 65, or I could sell a put at a lower price and get paid for my willingness to buy it at a lower price. Okay. So I'm going to go to the trade tab. Look at all these choices. Oh, I'm so overwhelmed. I don't know what to pick. Oh, yes, I do. Tyler gave me that tip, right? What did he say? He said 1 to 2 months. Okay, well, right now, a 1 month option is the Jan 20th. This is the monthly. Let's open that up. 32 days out. Okay. Oh, look at all these strike prices, right? The stock's at 65. You can sell a put that obligates you to buy it at 65 or 64 or 63 or 62, yada, 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 all the way down. You got a lot of choices here. Seems overwhelming, but I gave you a general guideline, which was maybe find one with a delta less than 20. Okay. So if I look here, I got a delta column already, and you can modify these to display whatever info you want, but delta looks good. So let's go down to the first one with a delta less than 20 is this one's delta of 16. It is the 55 strike price. So I want to sell that. I want to do a naked put. Okay, well, just click on the bid price. That's this column right here, the bid price. Bing, and it brings up a sell order. Now, does it say naked put in here? Nope. I just have to know that selling a put, by definition, is a naked put. I'm obligating myself to buy 100 shares of Okta at 55 bucks. The promise I'm making. Presumably, I'm a willing buyer there. I mean, that could be one reason I'm doing this. I may look at the chart and say, I'd be tickled pink if I could get this sucker down at 55. Sign me up. Willing buyer down at 55. Okay, put your money where your mouth is. You enter this transaction, puts you on the hook to buy 100 shares at 55. Now, you're not doing it for free. I mean, come on. Like, you got to pay me to do that. I'm not going to do it for free. They're going to pay you, well, the midpoint is $1.20. Let me say $1.20 to buy 100 shares at 55 bucks. Well, it's $1.20 per share, right? Remember, option contracts typically control 100 shares. They're priced per share. So you take the $1.20 times 100. You're getting paid 120 bucks here. It's not nothing. You're getting paid 120 bucks for your willingness to buy some shares of Okta at 55. Okay. Now, if Okta goes up over the next month, fantastic. This put expires and I make 120 bucks. If Okta goes sideways, this put will expire and I'll make 120 bucks. If Okta goes down, but down less than 10 bucks, because that's how far it has to go down to get to my strike, the put will expire and I'll make 50 bucks. Not 50, 120 bucks. And what's the likelihood of one of those three outcomes happening? Well, that's what the delta told you, right? Delta's probability here. I sold a 16 delta put. There's a 16% chance it's going to be in the money, which means there's an 84% chance it's going to be out of the money. Market's telling you there's about an 84% chance this put's going to be worth zero. Pretty high probability, right? Pretty high probability. If it goes below 55, well, then you're going to have to really decide, do you want to buy the stock or not? Is that why you entered this trade? Okay, so let's set up some rules here for exits. Yeah, hopefully you got the general idea on the entry here. So risk reward, it's probably worth bringing this. So how much can I make? Your maximum reward is the net credit, the credit received from selling the put. In this case, I got $1.20. Okay. The maximum risk, this is the strike price of the put minus the net credit. Now think about this. You are on the hook to buy the stock at the strike, which is 55. Okay. I may have glossed over this. The strike price, that's this level, this number right here. Okay. That's the price at which this deal has been struck. The person who bought the put has the right to sell stock at 55. The person who sold the put, you, has the obligation to buy that stock from them at 55. So 55 is the price we're talking about here, also known as the strike price. Well, how much are you going to lose if you have to buy the stock at 55 and the stock goes to zero? Oh. If the stock went to zero and you had to buy it at 55, you lose 55 bucks. Theoretically, that's your risk. But you did get paid $1.20 up front. So you get to keep that. So 55 minus $1.20 is 53.80. 53.80. That's your max loss. Okay. You think, wow, there's a lot of potential loss here. Have you ever bought a stock? Have you ever looked at the potential loss when you bought stock? It's the stock going to zero. Yeah, there's a lot of theoretical risk. Now, you don't have to hold it the whole time. You can get out whenever you want. But assuming you went on vacation and did nothing and came back and Okta was out of business, yeah, you're out to 53.80. I'd hasten to add, if you just bought Okta right now at $65.35 and it went to zero, you'd be down $65.35. So again, selling the 55 put and having 53.80 at risk is less risky than buying the stock right now at 65.35. Okay. I'm not increasing the risk of buying shares of stock. In fact, I'm decreasing it, provided you size properly. Now, I don't think it's going to zero. If it did, you're going to have plenty of time to get out whenever you want. But in theory, that's the risk. Okay. What's the cost of the trade? This is super important. Your broker could make you put up 53.80. Couldn't they? Couldn't they say, listen, Jimmy, you sold the put, not me. You're entering a contract that obligates you to buy the stock at 55. Given what you had paid $1.20, listen, your max theoretical risk is $53.80. I'm going to make you put that money up here. In which case, I don't know. I mean, it's not that great of a return because I'm making $1.20 on 53.80. I'm making a 2% return. Say, come on, Mr. Broker. You know this stock's not going to zero, especially in the next 30 days, because that's the lifetime of this trade. I mean, I'm not obligating myself to buy Okta at 55 for the next 25 years. I'm obligating myself to buy it at 55 for the next 30 days, 32 days. You know it's not going to zero, man. Hook me up. Make me put 10% of the max loss, 15% of the max loss. And then, I'm making a lot better return because, if I only got to put up $500, I'm making $1.20, really 120 on $500. I'm making a 24% return. What do you say, buddy, old pal? Like, don't, make me put up just a little bit of money. And the broker say, okay, deal. I'll make you put up a certain percentage of the stock price. So if you're doing this in a margin account, we sometimes call the cost the margin requirement. It's maybe 10% to 20% of the stock price, somewhere around there. And in the paper money, because that's what I'm illustrating this on, if you hit confirm and send, it'll actually tell you right here. It's called the buying power effect. Okay. Little tangent. Why Thinkorswim saw fit to refer to the margin requirement or the collateral or the cost of a trade as the reduction of your buying power is beyond me, because it's far more complicated than it needs to be. Okay. Nonetheless, that's what they've done. Okay. The buying power effect is the cost of the trade, the initial margin requirement, $550. So look, my pleas have not fallen on deaf ears. I asked the broker to not make me put up 100% of the stock price. They said, yeah, sure, we'll make you put up $550. And I say, oh, fantastic, because that makes this about a 24% return. Okay. Now I'll add here, excuse me, that with your risk being far in excess of the initial cost, it can go up, right? If Okta nosedives the collateral you have to support this trade can expand. Okay, so just one of the unique things with selling naked puts is they'll give you a deal if you're in a margin account and make you put up a little bit of collateral at the beginning. But rest assured, if the stock goes against you, you may have to expand that a little bit. And there's ways to model that, but we'll keep that for conversation on another day. Okay. Almost done here. I think we're doing good on the clock. Okay. Listen, 60 minutes max. I'm 45 and I'm feeling pretty good. Okay. But we're on the downhill here of this conversation. Is there anything else I need to put for risk reward? I got my reward. I got my risk, got my margin. Let me just mention probability of profit. I've already said this, but let me type it. It's 1 minus the put delta. Okay, so in this case, it was 1 minus my 20 delta, which is 0.8. Actually, no, I sold the 16 delta. 1 minus 0.16 is 0.84, 84% in this case. Okay. So, all right, so what's the game plan? What's the plan? Let's do target, stop loss, and I think we're square here. What could you do? You sell the put for $1.20, then what? Well, hopefully Okta bounces, okay, and it doesn't implode, and we end up above 55 at expiration, somewhere up here. In which case the put would expire. Your target could be ride to expiration and let the put expire worthless. Okay? Ride to expiration, let the put expire worthless, and then you made the whole $1.20. I mean, you're so smart. You knew this thing was going to stay above 55. Well played, well played. Put expires worthless. Okay. Some people, they're like 32 days. That's forever away. What if I make most of my money relatively quickly? How about I exit once I've made most of my money? Okay. You, my friend, are focusing on what we call ROTI. Return on time invested. Hey, if I make up most of my money in a short period of time, my profit per day is a lot better. Maybe I should just take the money and run. Maybe you should. It's a good idea. So what you could do is you could say, hey, I'm going to buy back my put, because that's what you do when you get out. You sold the put to get in, buy it back to get out. I'll buy back my put when I've made the majority of the profit. Majority meaning, I don't know, 80% plus of the profit. Now, a little math tip. How do you calculate that? If you got $1.20 and you want to exit when you've made 80%, take $1.20 times 0.2. 24 cents. That's when you should buy it back. When a $1.20 put goes to 24 cents, you've captured 80%. Okay. So some people will buy it back when they make most of their money, which if the stock goes up, you'll make your money quickest. Stock rips, you won't have to hold this 32 days. You might be out in 15 days. I've sold 30-day puts before and bought them back in a couple of days, right? Because the stock ripped. I'm like, dang, should have done something more aggressive, I suppose, but it happens, right? You sell enough puts, every once in a while you get lucky and you make most of the premium pretty quick. All right, final piece. What if I'm wrong? What if I'm wrong? We call this stop loss. Really, it's just trade management because I may not completely get out. If the stock tanks, okay, if the stock tanks, number one, you could ride to expiration and let the put get assigned. And now you will buy 100 shares of stock at the strike price. Oh, come on, Ty. You can do it. There you go. Okay. So, did it again. All right. So if I take a look at Okta and I say, hey, listen, if worst comes to worst, I am willing to buy this at 55 in a month. Okay, man. Then you go play golf. You come back in 32 days. And if by chance Okta's below 55, congratulations, you now own 100 shares of stock. Okay, it's yours. And you think, what's not to like about that? Like, why not just let the put turn into stock? Listen, I mean, most of the time it's probably good, but I will tell you that right now buying at 55 seems like a gift. It's like, ooh, who wouldn't want to buy it at 55? Well, that's because right now the stock's at 65, and it seems like, well, that's that'd be a gift. Sometimes it turns out to be punishment. Because what if Okta goes down to $35? Trust me, you having to buy it at 55 will be punishment. You're gonna be like, oh man, I don't want to buy it at 55 because everybody else is buying for 35. Tough luck, buddy. You made the promise to buy it at 55. You're on the hook for that. So in the event the stock plunges, sometimes getting a sign of what you thought was a good price ends up being a not so great price. That is the risk. That is the risk. My rebuttal would be, well, hopefully the drop to 35 is temporary, and with time the thing comes back up, right? Like you're not going to nail the low when you sell a put, but as long as I get a good price on the stock and I have a long enough time horizon, and I know how to maybe navigate or adjust the trade and sell cover calls and such to further reduce my cost. I mean, there's some other levers you can pull, I guess is my point. But there is risk here if the stock drops too far. The Goldilocks scenario is Okta just comes right down to 55 and it's sitting right around $54.50 at expiration. And you're like, yeah, sure, I'll buy it at 55 because it's like the current price, right? That's ideal. Sometimes that happens, but you just have to know that if the bottom falls out of it, buying at 55 can become punishment. It can become punishment. So if you're a willing buyer, you can do that. Some people aren't. They're like, listen, I'm not selling puts with the intent of being assigned. I want to just get out if it goes against me too far. I want to just pull the plug. This is just a high probability cash flow trade. And if I'm wrong, I just would rather hightail it out of here. So, you could exit if the stock breaks support and you're not bullish anymore. You could exit if the stock reaches the strike price and the put moves in the money, right? Because you just want to get out. I mean, there's a couple of options there as well. Okay. And you could automate that or put in alerts, on your order entry, a little bit outside the scope of today's conversation. But consent, actually, no, I will put in the two exits here for the final piece. Sold the put for $1.20. I'm going to right click and buy it back, create an opposite order. I'm going to close it at 24 cents because that would get me that 80% of the potential $1.20 profit. Good till canceled, because heaven knows I'm not going to hit that in one day. It's going to take a few days, at least. That's my entry. That's my target. And then I also want to buy it back if we hit 55. Let's say I want to get out if I hit my strike price. Well, there's a couple ways you can do this, but you can make it a market order, click on the cogwheel, and you say, hey, if Okta gets at or below my strike 55, I'm out of here. Buy back the put. Let me move on with my life. That is an example. Selling a put, buying it back when you made most of your money, or buy it back if you hit the strike. Okay. You will have a loss if you hit the strike, unless you hit it like day of expiration. And you can use risk graphs to kind of figure out what the loss is, how to use that particular tool. But that's kind of how you map out the trade. So it doesn't have to be different than a stock trade or any other option trade. You can map out entries and targets and stops, with a naked put, just like anything else. Final thought. The real power of a strategy is not when you do it once. It's when you do it time after time after time after time. So the real value of learning a naked put, just like with learning a covered call or some other option strategy, isn't in the one-offs. Oh, I sold that put once and it worked. No, it's a system. It's when you make it systematic. It's when you do it again and again and again and again that you get what the system is designed to give. And so I have found over time that naked puts are just a wonderful way of getting yourself neutral to bullish on a market or neutral to bullish on a stock. Not just this month, right? But every month or over time as kind of a core alternative to just buying and holding stock. And that's really one of the powerful ways of adding options to a portfolio is you go from the person who just is always straight long 100 shares of stock to one who is maybe sometimes long 100 shares of stock, but is just consistently using things like naked puts, like covered calls, like naked puts and covered calls to enhance the behavior of the stock position over time, right? So you can use it and be tactical. Where I really like it over time as a value add for me is again, as an accompaniment or an enhancement of just buying shares of stock. Why not get paid to buy something you're willing to buy anyways? Why not get paid to sell something you're willing to sell anyways? Investors who use stock and use the options market, specifically naked puts and covered calls, are simply getting paid month to month for their willingness to buy and sell. Willingness to buy and sell, willingness to buy and sell. Listen, if you're a stock investor, you're buying and selling stock anyways. Why not get paid to do what you're doing on a regular basis? All right. That's the naked puts for tonight. You guys have been awesome. I really appreciate you coming out. More to come. This was a taste of the types of webinars and things we do on the inside at tackletrading.com. As I mentioned, holiday sale going on right now. Forget inflation. We gave you deflation with all of these deals. We slashed the price of, I think, everything we do. On sale. Check them out. Got a few more, maybe a couple more days, a couple more weeks. I think we do it through December. But go check it out. And happy to have anybody who wants to come learn how to trade join us here at tackletrading.com. With that, you guys have been great. I wish you a Merry Christmas. Thanks for spending your night with me, and we'll see you next time.